Let me reverse it a bit and say, if I was taking an asset allocator's view, I'd worry about the US being expensive. And it is expensive. You look optically on PE ratios or whatever valuation metric you want to say, it does look more of a premium to the rest of the world. But it's been true of north of 10 years now, and it has continued to outperform. And the reason is twofold, really. The quality of businesses there and the high returns on invested capital that is possible, but also the emergence of technology. But let's think about it. The value creation by some of these large cap stocks is once in a generation type stuff. And I think, therefore, it probably deserves to trade expensive relative to the rest of the world. If I've got a concern about geography, it's probably China. In terms of where do we see opportunities, I still think technology on a 3 to 5 year view looks cheap. But also there's a bunch of sectors which, amazingly, are still suffering post-pandemic lulls. Whether that be in industrial automotive semiconductors, whether it be in bioprocessing, there are inventory cycles which still haven't fully unwound, and where natural demand is not yet coming through. I think in 2025, we're going to see some of those get back towards normal growth levels again. So I think, again, there's reasons to be optimistic into 2025. And if you look around the world, I think, the US has obviously led for over a decade, but I think we're seeing interesting things elsewhere. We don't really asset allocate in our portfolios, but I'm intrigued by what's happening in Japan. I remember the peak of the market back in 1989. We're a long way on from that. We've now retained the peak again, or regained the peak again. I think what's happening in Japan in terms of shareholder value, trying to run companies for the benefit of shareholders, to try and optimize returns, I think it's all really exciting stuff. Technology we've mentioned already. I think, the tech intensity of GDP continues to deepen, and that's going to really accelerate with AI as that gradually picks up pace. With that, there are a whole series of other areas. So building data centers seems to be really important right now. So all the derived demand from data centers, I think, is really intriguing. That's electrical equipment through to power supplies. Electricity consumption is now growing again. We've never seen that really since the 1970s. So again, something unique. It's all driving capital expenditure. So we seem to be in a capital expenditure-led decade. And that's reinforced by other long-term trends. It's reinforced by decarbonizing the world's energy supplies. It's reinforced by the geopolitics, where onshoring of production seems to be a trend. So all of that reinforces that capital expenditure is the solution to the problems. And that's without getting into potholes in roads and other issues where we need to replace aging infrastructure. Absolutely. I mean, in a way, Google itself, Alphabet, is almost becoming old economy. If you think about, online advertising as a proportion of total advertising, it's over 70%. And therefore, we can't expect it to grow at 20% per annum anymore. It's becoming more mature. There are lots of trends that are around and have been around for decades, which are still persisting. The fact that more people are spending money on plastic rather than cash, driving payments companies like MasterCard, still going to happen. The fact that e-commerce, we've been talking about e-commerce really since 2000. E-commerce is gaining percentage of total retail sales continuously and will do in the next 3 to 5 years. It's no longer the hyper-fast growth, but it's definitive growth. What we need to do is make sure that we actually find examples of companies attached to those growth trends that are high enough quality that they can actually make good profits out of those trends. Let's take the reverse. What are we not investing in that I think a lot of them are? Traditional consumer staples businesses. If you think about traditional consumer staple businesses, they grew revenues mid-single digit. They made some operating leverage through the P&L and grew profits at 10% per annum. But they failed to do that in the last 10 years. And what's changed? Well, actually, the route to market. The likes of Facebook, the likes of Google have enabled it much cheaper to get to market for things. So we're seeing brand fragmentation. I think there is a trend towards a growing number of breweries, both here in the UK, but also in the US. All products, the number of gins that are available, etc., all small producers that can get their message to market more cheaply and compete with the major brands. And as a result, consumer choice is moving in the same direction, and it's broken their algorithm. So we don't have as much in the way of staples investments right now. Conversely, if you look at a recent example of purchase that we made, Smurfit Westrock, they produce cardboard boxes and the bits that make the cardboard boxes. Not a traditional area for us. It tends to be relatively low growth, quite low returns on invested capital, too much competition. But what we're seeing is industry change. The top three now, Packaging Corp, International Paper, and Smurfit Westrock, have now consolidated the market. They now control 2/3 of the industry. And much more important than that, we're seeing managements that are no longer pursuing growth, but instead prioritizing value over volume growth, particularly at International Paper. And I think what that is going to do is transform returns on invested capital in the industry, not unlike the equipment rental guys back in the GFC. And I think we're going to see a much more profitable period over the next 10 years. That would be atypical for quality. But what we're looking for is not just quality, but change in returns on invested capital as well.